In today's episode, we pledge to either save you money or make you some money through our analysis and insight into Toronto's commercial real estate investment market, third quarter 2020. Hello and welcome back everyone to another edition of CRE Next Work Out Loud. My name is Mel Giannone. I'm a real estate broker in the Greater Toronto market, specializing in the exclusive representation of tenant occupiers and owner investors of commercial property. If you're new to the channel, we share helpful insights on the current real estate market so that you can make better business decisions for your company and for yourself. So if you play a role in shaping real estate strategy for your team or are looking to invest in commercial real estate, make sure you like, subscribe, share, and tap that notification bell so that you don't miss any new content as soon as it's released. In today's episode, we pledge to either save you money or make you some money through our analysis and insight into Toronto's commercial real estate investment market, third quarter 2020. As always, for those of you new to real estate, we'll keep it very simple for you to understand. For those of you who are seasoned vets, you'll find the data here very interesting and relevant. Since we'll be taking in a lot of information together, feel free to pause this presentation at any time to explore in more detail some of the data introduced to you here. Now, if you're ready, let's get you updated on the market post Q3. Here we go. If I could take you back to our first initial presentations, we projected the overall economy would trough by the end of this upcoming flu season, before the start of the next new sustained economic expansion. We called for that bull run to start somewhere between the milder months of April and September of next year, barring any successive second or third infectious waves before that. Otherwise, we would anticipate a stall in that economic expansion until later fourth quarter 2021, or even pushed into 2022. Well, guess what? As of October 10th, we took a step back these past few weeks, re-entering into a modified stage 2 and possibly planning for a return to lockdown measures, maybe modified, as witnessed in Europe. I want to share with you some insights as to how this will affect the Greater Toronto Area commercial real estate investment market going forward. 1, we'll discuss the current factors influencing decision-making. 2, from an investor's perspective, we'll measure the health of each asset class. And lastly, 3, we'll reveal the best building product types that should be on your radar. Let's begin by talking a little bit about the state of the economy, government policy, and monetary strategy, which are all influencers of investment decisions. Up to now, we've heard a lot about the rebounding V-shaped recovery in the equity markets, residential real estate market, and most of the industrial sectors of the economy. In reality, though, it's better described as an economic alphabet soup made up of letters V, K, L, or W, depending on which aspect of the economy you analyze. Even our interpretation of the healthcare crisis is confusion. Is this good or bad? Early on, prior to the summer months, Canada ranked 17th in the world, before dropping down to 19th by late June. As of November 1st, Canada ranks 31st among all other countries in the world and still remains almost last among G7 nations, with the exception of Japan. Canada's COVID rates of recovery and deaths have extremely improved since the start of the pandemic, although total case numbers have garnered all the focus and attention from the media. So, as you can see, the conflicting debate between lives and livelihoods is still causing confusion among certain Canadian citizens, Canadian politicians, Canadian companies, Canadian stock markets, and Canadian real estate investors. In relation to recent past, most economic numbers are trending in the right direction. The stats are improving due to the government stimulus money, which has more than adequately funded the markets. There is an argument to be made as to whether the federal pandemic relief programs are poorly designed, discouraging people from going back to work. Others would argue the government-mandated restrictions and financial support has inefficiently and indirectly created a recovery split between higher income earners and lower wage laborers. who lost no less than 80% of the jobs, between goods producing sector, which benefited between 70 to 80% of the government stimulus, versus the service producing sector, which lost most of the jobs, between large tech savvy companies and struggling small entrepreneurial businesses, all resulting in a K-shaped recovery. A rebound for some, while others are challenged with a continuing recession. The Bank of Canada has announced we've entered into a recuperation phase, recalibrating its quantitative easing program down to $4 billion from $5 billion in weekly large-scale asset purchases. It currently owns over 30% of Canada's sovereign debt, which is expected to rise up to 50% by year's end 2021. As part of their reduction plan, on October 28th, it had ceased repo, bankers' acceptance, and Canada mortgage bonds purchases, as they no longer needed to assure liquidity in those markets. Instead, the Bank of Canada will shift purchases towards the longer end of the yield curve, the longer-term bonds, which have more direct influence on the borrowing rates that are most important for households and businesses. So, investors, interest rates will remain low for the foreseeable future. That sounds good for borrowing. What is concerning, though, is that we might not be able to raise them enough when needed, since most debt today couldn't be refinanced at a much higher rate without causing a degree of delinquency and default. Couple that with our export dependency to the US, increasing interest rates would raise the value of our dollar out of favor with our importer neighbors down south. So we are somewhat at their mercy and might just be locked into a low interest rate period for many years to come. Over the last decade, we've only seen them generally come down, and those were during the best of times. Here are how the numbers play out statistically entering this last quarter of 2020. The money supply keeps growing, along with real GDP. In proportion, the federal debt as a percentage of GDP is expected to rise from 31% at the start of this year to 49% by the end of 2020. That's almost half. Nevertheless, Canada's debt to GDP remains low for now, the lowest among all the G7 nations. Be forewarned. Increasingly, there has been more discussion among G7 nations about supplementing our fiat currency, our sovereign cash, with a digital fiat currency. All the more reason for investors to place their money into hard assets like real estate to offset the inevitable erosion of value. And you thought real estate was expensive now. The rate of inflation remains relatively flat along with the velocity of money trading hands. As the unemployment rate declines slowly, we expect more dollars to circulate. However, the Canadian household savings rate reached record highs last quarter, which suggests there are fear and uncertainty factors still having a strong influence on the economy. A high savings rate should combat Canada's high household debt problem, curbing risks away from future credit delinquencies and defaults. The bad news is, most of the decline in spending came from high-income earners, those least affected by the crisis, while low-wage earners exhibited a higher propensity to spend their income on necessities, essential goods, and shelter, making them most vulnerable. So, if by chance you're a real estate investor of retail property catering to affluent neighborhoods, your small business tenants most likely felt a steeper decline in revenue versus those other businesses located in less affluent neighborhoods, catering to low-income earners who spent more of their money more frequently. With one of the world's lowest birth rates, Canada's population weakened substantially throughout 2020, growing at a slower pace than usual. Absent from helping growth was traditional immigration levels, restricted due to the pandemic. The flow of newcomers waned over the past few quarters, well below 2020 targets. It's estimated that there were 64% fewer new permanent residents admitted in August, compared to August 2019. To make up for lost ground, 28,450 invitations to apply were issued in the third quarter, the all-time largest number on record for Canada's monthly express entry draw. It also brings this year's total to a record high of 78,350. The applications through express entry take an average of 6 to 8 months to process, so the number of people who actually get permanent residence from these draws won't be seen until 2021. The Minister of Immigration increased Canada's future target levels on October 30th. This could be the great turnaround signal for most condominium investors they were waiting for. The new plan will ultimately benefit the condo and apartment rental market, as most immigrants rent when they arrive in Canada before moving towards home ownership. Ontario is the most popular province for Canadian immigrants. I hope these immigrants come with boatloads of cash next year, because with an unemployment rate highest among all the G7 nations, it will be some time before they can settle in. The economy has rebounded from its lows in the first quarter with multiple months of consecutive increases, but only to a level almost reached back during the worst point of the financial crisis in 2008. We currently sit at around 4.7, negative 4.7. Back then, we only sank to a level of negative 4.5. We know it took North American markets roughly 1 to 2 years to recover from that point. And this second wave of infections right now will ultimately do its part to slow our progress over the next quarter or so. So the Bank of Canada predicts GDP won't see a return to pre-pandemic levels until 2023. And because of this resulting slack, it has reiterated its commitment to keeping the benchmark rate at a quarter point. And target for inflation remains at 2%. So carrying on with this economic alphabet soup analogy, we saw equity markets take a V-shaped recovery, while bonds resembled an L-shape or flat, and components of our GDP forming U, W, and K-shaped recoveries due to bifurcation between sectors. Although overall mortgage rates are declining, the heightened uncertainty has widened the spread between 5 and 10-year Government of Canada bond yields and 5 and 10-year commercial mortgage rates. The range in cost of borrowing money between best-in-class and worst-in-class properties could vary by up to 1.7%. Similarly, cap rate spreads ticked up in Q3 as risk was being built into investments. Overall cap rates for the Canadian Class A downtown office investments grew Q3 over Q2 to 5.58%, up year over year from 5.36%. Downtown Toronto, Class A office investments are roughly a point lower. Office investment volume was up Q3 over Q2 by 14%, but still remains down year over year by 71%. Investors sought security and safety in the industrial asset class, with overall cap rates in Canada compressing slightly to 5.33% in Q3, down from 5.36% in the previous quarter. Industrial property within the Greater Toronto Area is roughly a point or so lower, so we can see a cautious optimism growing within this asset class. Overall, however, Canada's industrial investment volume was down by 61% quarter over quarter, Q3 over Q2, while still remaining up year over year by 8%. The trend demonstrates that industrial properties remain the belle of the ball when it comes to choice commercial real estate investments. Similar to industrial asset class, overall cap rates in Canada for multifamily residential compressed Q3 over Q2 in both urban and suburban markets, while Toronto's cap rates remained relatively stable. Retail investment volume in Canada was up by 6% Q3 over Q2, but still down year over year by 28%. Tier 1 regional malls across Canada showed stable cap rates at around 5.29%, while Toronto's inched up slightly. Cap rates for retail are expected to increase as the retail apocalypse continues. Overall, commercial real estate investment volumes were down in the third quarter by 15%, year-over-year investment volumes are still down by 29%. Good news from lenders, capital is more readily available for assets that are either industrial or multifamily, best-in-class, well-located properties, investments that demonstrate stabilized cash flow. However, for opportunities that don't follow under these criteria, lenders will require more reserves in some cases to mitigate against risk. Borrowing costs will also increase with risk, and it'll take much longer for deals to close as lenders dig much deeper into their underwriting. With the advent of this second wave of infections affecting the markets, investors and lenders will most likely return again to a more cautiously optimistic approach over the next quarter in preparation for better conditions ahead in the new year. So let's wrap up things with some commercial real estate investment suggestions. In our earlier presentations for the investment market, we proposed sheds and beds, industrial and multifamily residential as the best asset classes to focus strategies around. A recent report from PricewaterhouseCoopers reveals other building product types that should have your attention going forward. Let's begin with warehouse, logistics, and fulfillment center type industrial properties catering to the growth of e-commerce and the last mile delivery of products now on an hourly basis. Industrial data centers for cloud computing, virtual learning, and running the Internet of Things. Cold storage and self-storage facilities for catering to the grocery, food service, pharmaceutical industries, and families. Healthcare real estate, such as research and development labs for the med tech industries, medical office buildings, and retail healthcare outposts next to regional hospitals. Low-rise multifamily residential, triplexes, duplexes, and single-family rentals should also be on your radar. Flex office buildings in suburban markets, and lastly, low-rise office buildings in suburban markets. For the time being, I'm recommending my clients stay away from everything else until we gain a solid understanding of what the new normal means for real estate investing. I would encourage you to stay on top of real-time data, stay vigilant of the opportunities we've revealed here, and stay active in the market with me, Mel Giannone, your trusted source for occupancy and investment solutions in Toronto's commercial real estate market. Well, that's all for this episode. Hopefully you found some value in the data presented today, along with some insight into current market conditions, trends, and in knowing which future prospects look best. As always, my goal is to help you save money or make a lot of money through these episodes of CRE Next, Work Out Loud. So if you like what you heard, please don't forget to like, subscribe, share, and tap the notification bell so you don't miss out on any new content as soon as it's released. Thank you for your time. For real estate opportunities together, I can be reached by telephone at 905-567-5602 or by email delivery to mel@Paramount Real Estate, or communicating through the comments section if you're watching by video or listening via podcast. Until next time, stay well.